Forex trading, short for foreign exchange trading, is the process of buying and selling currencies with the aim of making a profit. It's the largest financial market in the world, with trillions of dollars traded daily. Here's a breakdown. 1. Currencies. Forex trading involves trading currency pairs where one currency is exchanged for another. For example, EUR/USD, Euro/US dollar, is a common currency pair. 2. Market participants. Participants include banks, financial institutions, corporations, governments, and individual traders. Their purpose: traders engage in forex trading to profit from changes in exchange rates. They speculate on whether a currency will strengthen or weaken against another. 4. Leverage. Forex trading often involves leverage, allowing traders to control larger positions with a smaller amount of capital. This amplifies both potential profits and losses. 5. Market hours. The Forex market operates 24 hours a day, 5 days a week due to its global nature. It opens on Sunday evening and closes on Friday evening, UTC. 6. Tools. Traders use various tools such as technical analysis, fundamental analysis, and trading platforms to execute trades and analyze market trends. 7. Risks. Forex trading carries significant risks, including market volatility, leverage-related risks, geopolitical events, and economic data releases that can impact exchange rates. Overall, Forex trading offers opportunities for profit through careful analysis and understanding of global economic factors influencing currency movements. It's essential for traders to manage risks and stay informed about market conditions.